Hello guys, this is Six Bulls Trading. Today we'll be going through a webinar that we had a couple days ago regarding trading futures. This is in collaboration with AMP Global and Barbara Cohen. So in this webinar we'll be talking about the differences of Forex and CFDs with exchange traded futures. We're talking a little bit about common trading mistakes that traders do and much more.
Well, good morning, everyone, and welcome to the AMP Global Introduction to Trading Futures. Before we get started, we always have to make our attorneys happy. So just a couple of words here. Trading is not for the get-rich-quick. You'll need to make your best effort to learn. There's a potential for profit and also a potential for loss, and never trade with money you can't afford to lose. So with that, let's get started. The first thing I wanted to talk about today is what I consider to be the key to success to someone who wants to trade long duration. And I consider this to be the most important thing. And as you'll see in just a few minutes, why this is such an important aspect to trading. And that is, when you're trading, instead of looking at the current trade, looking at how much money you're going to make on that trade, the first thing you should always worry about is how you're going to defend your portfolio, the money you already have on account. You always want to worry that that money is secure before you worry about making future money. The reason this is so important is because when it comes to trading futures, and these are a little bit different than, let's say, if you're used to trading Forex or stocks. When you're trading futures, futures are based on programmatic algorithms. It's a very different thing than stocks or Forex. And because of this, because it's based on an algorithm, and I'll show you how that algorithm works in just a minute, because of this, it is really essential that you develop a strategy for yourself. And you'll develop that strategy using a demo account. You can get a demo account from AMP Global, and you'll see I have an account that I'm going to show you in just a few minutes. And you get a demo account and you build yourself a strategy. And it's going to take time to build that strategy. And you're going to work on it and you're going to work on it. And the key to this strategy, and there could be lots of elements, what the chart looks like, etc., but there have to be at least two elements in that strategy. There's an element of offense, how much you want to make on a given trade. And this has to be consistent. It can't be, well, this time I make this and then next time I make that. No, it has to be a consistent win. How much can you logistically win on a trade without going into greed, without losing? How much can you consistently win? And the other element of that strategy has to be defense. When that trade goes against you, and trust me, not all trades are positive, when that trade goes against you, when do you get out of that trade? And holding trades till you no longer have a portfolio is not the ideal situation. And when you're trading futures, because of the algorithms that are part of trading futures, you only want to trade with your strategy. I can't stress this enough. This is really important. You can go on the internet and you'll find lots and lots and lots of strategies on the internet that you can buy, people selling. I always tell people, never buy a strategy that you find on the internet. And the reason is because you don't really know anything about the person who's selling that strategy. You don't know how much money they have in their portfolio. You don't know the way that they trade. Maybe you're very conservative, maybe they're not. buying somebody else's strategy isn't trading from your own comfort zone. So you need to develop your own strategy by testing and testing and testing with a demo account. And once you've done that, you'll know the two elements in your strategy: how much you can win consistently and when to dump the trade when it's a losing trade. Let's say, for example, that your strategy has 4 elements in it. And this particular moment, when you're looking at the chart, 3 of those 4 elements are ready to go. And you say to yourself, yeah, 3 to 4, I'm going to take the trade. Wrong. That was not your strategy. And that's how people lose money trading. They stop using their strategy when they're trading live. And with trading futures, with the algorithmic programming that they have, this is not the way you're going to stay trading futures for a long time. So once you've developed your strategy and you've been doing it on the demo account, now you're ready to transition to trading live. Used to be when you transitioned, you would go from demo to what are called mini futures. But a couple of months ago, the Chicago Mercantile Exchange, that controls trading futures, developed something called micro futures contracts. And because of that, now you can transition from demo to micros. People don't realize there's a huge difference between trading a demo account and trading with real money. On a demo account, if you lose money, you go, oh, well, it was a demo. But when you're trading live, you don't get to make that statement. And so having that ability transitioning to micros as opposed to minis, you may not make a lot of money initially, but you won't lose a lot either. And until you get your feet wet trading with money, this is a great way to go. You go to micros. Once you're doing well with micros, then you go to minis, and then finally you go to the standard contract. So for those of you who are unfamiliar with futures, let me just tell you what a futures contract is. Futures are known as forward contracts. Depending on what you are doing in the contract, and it's a contract between a buyer and a seller. So if you're the buyer of the contract, and this could be whatever you're buying, could be a commodity, could be a financial instrument, whatever it is. If you're the buyer in the contract, you have the right to buy that asset, whatever it is, from the seller at an agreed upon date and agreed upon price sometime in the future. If you're the seller in the contract, you have the obligation to deliver that asset, whatever it is, at the agreed upon date and time and price sometime in the future. So traditionally, these futures were really set up for commodities. The example I like to give is, say, for example, that you're a bread manufacturer. And being a bread manufacturer, you need a certain amount of wheat every year to make your bread. Now you have 2 choices. You can either wait until you run out of wheat, go on the market and hopefully find some wheat, and who knows what price you'll have to pay, or you can contract with a farmer for the amount of wheat that you need at a specific price to be delivered in the future. So most bread manufacturers who want to maintain that certain level of availability and they want to know what price they're going to pay, they opt to contract with a farmer. Now, if you're the farmer, you're going to be the seller in the contract, you have 2 options. You can wait until harvest time when your wheat is ready to go and hopefully find a bread manufacturer, or you can find a bread manufacturer while your wheat is still in the ground, contract with them for delivery at the given price, and now you know how much you're going to get to keep your farm running. And so that's how futures were originally set up between commodities such as wheat, rice, corn, etc. That's what they were originally set up to do. But bankers came along, and bankers being bankers, they wanted to get into this trading activity as well. But they didn't want to trade commodities per se. They didn't want to trade wheat, rice, and corn. And they said, look, we've got something else we can trade that goes up and down. We want to trade financial instruments, such as the Dow or the S&P 500 or the DAX or the FTSE or the CAC. But we don't want to wait till like sometime in the future when it's harvest. We don't need that. We want to be able to go in and out of these things whenever we want to. And so the Chicago Mercantile Exchange said, okay, that's fine. We will make futures for you, the bankers. And so they did. They created financial futures, which is what most people trade if you're not a farmer or if you're not a bread manufacturer. That's what most people are trading, the financial futures. Well, the problem with the financial futures that were first created for the bankers was that they were very expensive to trade. Now, those futures are still available, and the bankers trade them all the time, but they're expensive. So the retail traders came along and said, well, that's great for them, but how about us? And so the Chicago Mercantile Exchange came along, and they created what are called E-mini financial futures, which are like 1/10 the size of the normal contract, so that everybody could trade. And that's what most people were trading. In fact, the E-mini S&P 500 is the most popular future traded amongst all futures that exist worldwide. Well, that was great. And up until about 2 months ago, that's about all that they had was E-mini futures for retail. But the Chicago Mercantile Exchange said, okay, well, listen, we can do one step better. We can go 1/10 of a tenth, and we will make micro futures. And so that's what they did. They decided to make micro future availability for retail customers. So now when you're transitioning from demo with your strategy, when you're transitioning from demo to live account, now you can transition from demo to micros. Again, get your feet wet. If you lose a little money, you're not going to be losing your whole portfolio. So here are the various micro futures that are now available. And pretty much all the financial futures that were available for bankers are now available as micros. And you can see that although you don't make a lot of money, your exposure to your portfolio is very small. So for example, if you're trading the S&P 500, you have a chance to use day margin. Margin is how much money you need in your portfolio to trade during the day. And for the S&P, for the Dow, these are very small amounts of money, $40, $50. The Russell you can trade with 25. For those of you who are used to trading Forex, they even have the futures side of Forex, which are primarily just the majors, the euro, the pound, the Aussie dollar, yen, Swiss, and Canadian. Those are your majors on the Forex side, and they have the future side of them as well. If you were to look at a chart, for example, for the euro Forex, and you look at the chart for the euro future, the chart's going to be the same. The price of a euro USD versus a euro future is the same. That's not going to change. So you could definitely trade the futures Forex as well. Although most people, I still think, trade the Forex side as opposed to the Forex futures side if they're going to trade the currencies. But for trading the actual financial futures, this is a great way to start with the micros. Many of you may have already been trading CFDs to trade these financial futures. If we look at the exposure and what you need to trade, there's no reason to trade CFDs anymore. If you want to trade a contract for S&P 500, for example, on the CFD side, you can do that. But look at the difference in what you need to trade. And for the same tick value, $1 per price movement. So if you're going to trade a micro S&P 500, you need $40 margin, but on a CFD, you need $1,400. So the nice part about these micro futures is that there's really no reason to trade CFDs any longer because the profit and risk factors are just not there. You always want to look at the risk reward. So how much am I going to risk and how much am I going to get? Well, if I risk $40, I can get $1.25 versus $1,400 for $1.25. So that would be nice to stay as a risk reward factor, keep the margins low. One difference for those of you, especially who trade Forex, one difference about micro futures and all futures in general is that they do expire. And it's something you really have to watch. And you have to kind of get used to this with futures. And it doesn't matter if it's micro futures or mini futures or the standard contract, they do expire. Most of the financial futures expire quarterly. And when they expire, their name changes. So you have to be careful with this because when the name changes, you don't want to be trading the old contract, you want to be trading the new one. So when we look at how the name is created, what it's comprised of, there's always the first three letters. And for example, the S&P 500 E-mini is MES. So there's the three letters. Then, depending on the quarter, there's another letter. If you're trading, for example, the September contract, it's a U. And then finally, a 2-character year. So, for example, the September contract for the S&P 500 is MES U19. That's an example. Gold is a little bit different because it expires every 2 months instead of every 3. So again, if you're going to be trading gold as a future instead of, let's say, the Forex side, then it expires every 2 months. The contracts expire the third Friday of the last contract month. But here's the deal. You never, ever want to be trading the current contract the last couple weeks of the month. You never wait till the last third Friday to be trading that. And the reason is because those financial futures belonging to bankers get very volatile the last couple of weeks. These guys are not trading in and out every day. And so you don't want to wait till the very end. I always tell people a couple weeks before the end of the contract, move to the next contract. So here we are in the middle of September, and that contract's about to expire. You should already be trading the Z instead of the U. Trade the Z, MES Z19 instead of the U19. You can always trade in advance of the new contract starting. That's okay. You can always do that. But you never want to wait till the very end. So right now, I would say be trading MES Z19 for the S&P 500 because we're already in the middle of September. And the other way you can tell is that the volume of those contracts will start to go down pretty quickly. They'll start to go down. The current contract's volume will go down. The futures contract volume will go up. So you'll kind of know, look, the volume isn't there anymore. I better move to the new contract. Now let's talk about times to trade. You can trade futures very similar to the way you can trade Forex, starting Sunday at 10 p.m. GMT to Friday, 9 p.m. GMT. But here's the deal. Some of these contracts will trade better at, at different times. So for example, take the S&P 500, the Dow, and the NASDAQ, and the Russell. Those are the most popular futures contracts. And these four contracts are American products. They really trade better during the American market times. So if you're looking to trade those guys, look to trade sometime from 12 p.m. GMT to 6 p.m. GMT. What I'm saying to you is you want to trade pretty much the market in the morning in the US market. And there's a reason for this. If you look at a contract, S&P 500, and then you look at its chart. So if you look at the chart for the S&P 500 and you are trading the standard contract, the mini, or the micro, chart's going to be the same. Price is the same. Activity, same. So it doesn't really matter which of those you're trading. They're going to look chart-wise the same. Well, in the morning session, the bankers are in control. Bankers care about one thing. They have their strategies, and they care about one thing, defending their portfolios. In the morning session is when they do most of their trading. And so when you look at the charts, you'll see a lot of activity in the morning up until probably 2 o'clock in the afternoon, New York time, which would be your 6 p.m. GMT. If they make money in the morning, bankers don't trade in the afternoon. They are going to defend their portfolios and they're going home. They did what they had to do. If they are not successful in the morning, then in the afternoon, they're going to try to make it back. Then in the afternoon, they're going to not try to make more money. They're going to defend their portfolio and just make back what they lost, which means in the afternoon, things get very, very crazy, very volatile, up and down, while they're trying to make back their cash. I always tell traders, especially retail traders, trade in the morning when they're trading by their strategies more than they're trying to make back the money they lost. And the other thing you need to know about trading in the afternoon, very important, most people don't know this, there's another market called the bond market. This is where bankers really trade heavily. And they're trading, these are like government bonds. You know, they're trading overnight government bonds, such as, for example, you know, trading the US markets bond or the German bond or the whatever. Those US, those actual country bonds is what they're trading. So now that bond market that they're trading, and again, they set up their bonds and they know exactly what they're going to do. And bonds are based on, they could be based on a lot of things, mostly political, how the governments are run, are they stable governments, who's in charge of the governments, etc. And that's what people invest in, that's what the bankers invest in heavily, on those bonds, government bonds. The bond market closes about an hour and a half before the stock market closes. And so what happens with and they use futures for this. So what happens in the late afternoon, the bond market closes and all those traders from the bankers come running over to the futures market. And what they do is whatever position they have on their bonds, they're going to take the opposite position in the futures market because they're defending their portfolio. This is why I'm saying everything is algorithmic. They all know about how futures work. So they're going to defend their portfolio, and so they're going to take an opposite position. Then if something should happen to that country that they have bonds in overnight, something happens politically, environmentally, the new tariffs are put in, whatever happens overnight, they may lose in their bonds, but they'll make it up on the futures. And so they've defended their portfolio and they haven't got a loss because that's all they care about. To keep their jobs as traders for the bankers, they need to make sure that their portfolio is always intact. It's nice to make more money, but you never want to be on the losing side and say, gee, I lost all this money. And so that's what they use futures for in the afternoon, which is why I tell traders who are retail traders, stay out of that market. That's very volatile at the very end of the day. And the other reason you want to stay out of that futures market is what happens is the market closes for a very short period of time, and they do what's called settlement. At that point in time, the Chicago Mercantile Exchange takes all the trades and they put them onto the people's actual accounts. That's called settlement. Well, during that settlement period, that margin that you got, that really day trading cheap margin, goes away. And then it becomes what's called maintenance margin. And it's only for a very short period of time. But you would have to have more money in your account during that very short period of time from 8:55 to 10 p.m. GMT. You have to have maintenance margin. So I tell people, stay away from that afternoon session. Just stay away from it, and you'll never have to worry about maintenance margin. You won't have to worry about what the bankers are doing. Stay away from the afternoon session at all. Then if they have lost money in the morning, you won't get into their craziness in the afternoon. The morning session is always a saner place to trade. So the question becomes, which of these, now I'm going to show you which of these four financial futures would you like to trade. So we're talking about the S&P 500, the Dow, which is the Dow 30, the NASDAQ 100, and then the Russell 2000, which are the 2000 small cap stocks. And the answer to this, when you look at this, is when you say, well, which one should I trade? The answer is it really doesn't make any difference. Because they're all pretty much, when you look at their charts, they're all going to pretty much be the same thing. For example, if you're going to trade the NASDAQ 100, well, those 100 stocks are also inside the S&P 500. It's the same stocks. And the way indices work, they're called weighted indices, which means the stocks that are more expensive stocks like Microsoft and Amazon and Google, these big heavy stocks are what drive that whole pricing of the index. A stock that's trading at $1,000 a share is going to have more impact on that index than a stock trading at $15 or $20 a share. And so when we look at these charts, well, the Dow 30, those 30 stocks are also in the S&P 500. So the charts are basically going to be the same. Once in a while, and you will see this once in a while, but you will see it, sometimes the Dow moves a little bit ahead of the S&P 500, just like a fraction. Maybe, a minute can be even as much as a minute earlier. So if you're trading the S&P, you might want to bring up a chart for the Dow, watch the Dow, and if the Dow makes a certain move, then you should look to the S&P to make that same move. But again, very, very, very similar moves. If you're trading the Russell, and what's nice about the Russell is that the margin is only $25. The Russell, you can expect to have the same chart movements, but they're going to be smaller. And there's not going to be as many people trading them as you're going to find if you're trading for especially the S&P 500, which is that's the most popular one of all. And again, if you're going to be trading from transitioning from demo to live, you want to start with the S&P 500 micro, the MES, and then from the micro you trade to the mini, and instead of making $1.25, you make $12.50 per contract, per tick, right? One price movement. So moving up, the chart is going to be the same. The micro and the mini are going to be the same. And once you've gotten your feet wet and you feel comfortable trading with live money, then move up to the mini. And of course, you'll find that the S&P 500 E-mini contract is the most liquid contract of all the contracts that exist. That's where people really trade. So here's something that I want to go over with you. And I'm going to show you some actual charts today and show you what I'm saying to you happens every day. So I've delivered this seminar to hundreds of people. And I always ask people, if you were to identify one reason why you had a loss, what would it be? And so what I've discovered is that the real reason people have losses when they trade is because they don't know the difference between a true reversal from what's called a momentary pullback. And this is the difference between trading short-term and being a long-term trader in the futures market. With a true reversal, the market direction has changed. It was going up, now it's going down. It was going down, it's going up. A true reversal is an actual change of direction in the market. And you'll see it as a major move. That's a true reversal. Such as here, you see that the market has actually decided to trend up and it's going much higher. That's a true reversal. In a momentary pullback, which is really the way that the market trades, the market was uptrending, it was going up a little, and then it stopped and paused. It came down a little bit, stopped and paused and continued to go up, stopped and paused, came down a little. The way the market really trades, and this is the norm, not the exception, the way the market really trades is in stepstones. It goes up a little, comes down, goes up a little, comes down, goes up a little higher, comes down, goes up a little higher, or going the opposite direction. It was already up, came down a little, went up a little bit, came down some more, went up a little. That is the way the market actually trades. If you look at any chart any day, you'll see that kind of movement. And that's what makes it very difficult when you're trading. And I don't care if you're trading futures or Forex or stocks, this kind of trading is hard. It's hard to know, was it a pullback or was it a change of direction? Was it an actual reversal? And this is how you have this is where you have difficulties in trading. Even in true reversals, you'll see momentary pullbacks. Even there, you'll see momentary pullbacks because that's the way the market trades. But here's the problem for most traders. Deciding, is the market coming back down or is it continuing to go up? When you look at a chart, for example, this is an example of what you would see on the chart. You would say, okay, here I am. This is what I see on the chart. Now, is that next minute, next 5 minutes, whatever I'm looking at, now is it going to continue to go up or is it going to come back down? And that's what you would see when you look at a chart. Well, in this case, it was a nice big amount of movement on the price, but that was it. And then it changed direction and came back down. Because what was this one big price movement here? that was a momentary pullback. It wasn't a change of direction. But when you were looking at it from the moment here, how would you know, is that a price pullback? Is that going to be a momentary pullback, or is that going to be an actual change of direction? And when we look and see what happened, well, it was a momentary pullback. It wasn't a change of direction. But here's the thing. Most people thought it was a change of direction, and they all lost. That we see every day, all day long, day in and day out. If you were a fisherman, if you ever go fishing, you go on a boat, a lot of fishermen, what they do is to catch fish, what they do is what's called chum the waters. They throw in some bait, whatever, live bait, the fish get excited, and then they throw in their lines so that they can catch the fish. In the world of trading, we have that same concept. Unfortunately, most traders get chummed. They don't know, is it a pullback or is it a true reversal? And most traders get chummed. And that's how most people lose money in the markets. They get chummed. Again, these are financial futures or even regular futures, or you're trading Forex. You're going to get chummed in the Forex market too, because of not having a strategy to identify a pullback from a true reversal. That's why having a strategy is so essential, and having worked on that strategy so that you can identify the difference. If you can't identify the difference, you're not going to be a trader for very long. Not an exception. This, unfortunately, is the norm. You'll see this every day, and I don't care what you're trading. This is the S&P 500. People jumping in. More examples. More examples. This is the NASDAQ. It happens on the NASDAQ. Russell 2000. It doesn't make any difference what you're trading, because you're going to see this every day. And just to show you this, those are some examples I pulled, but I'm going to show you something for just a moment. This is your live market today. This is what's happening right now, right? These are today's markets. So here's the one on the top is the S&P 500 E-mini. This is the euro down at the bottom. Over here is gold, Forex gold. And, the one on the top is the NASDAQ, and the one on the bottom over here on the lower right is the S&P 500. Now, we're going to look at some of these because you're going to see the exact same problem that you saw with the examples I just showed. Now, this is one that just happened. So let's look at this. This is the S&P 500. So there it is. You can see that everybody was trading. I'll make this chart a bit bigger so you can see that. And look what happened. Everyone traded at the top. They all went long. And what happened? The market came down. Now, when you're looking at that, what did you see? This is what you saw, right? That's what you actually saw right there. And then what ended up happening is that the market came back down. But everybody jumped in at the high. Look at this one over here. Here's your euro. And look what happened. Everybody got excited. Oh, the market's coming down. I got to jump in and get part of this, right? They're trading and trading and trading. And this is what you would see. And look what happened. That was the end of it. But everybody was trading down at the very end, even though the market was about to change direction, because they couldn't tell that that was it. That was the end of the trade, because they didn't have a strategy to tell them that. And this is an indicator that I have. This is one that I built myself. It shows me the what's happening. Now, normally with Forex markets, you can't see volume. But this is an indicator that I built myself, which is part of what we give away. This is an indicator that shows me what is happening real time, how people are trading that particular moment. And you can see some of them are half red, some of them are half red and half green. So I can see, are people really buying and selling, or are they just buying, or are they just selling? In this case, they were really selling at the very end, even though it was a little late, right? Here's a gold one. And again, this is what you would see as a chart. This is what you see, right? And then what ends up happening is people get in at the very end. We've seen this so many times. I just can't tell you. This is where people are right here. This is what you would see. Lots of trading at the very end. This is, again, if you were looking at that chart, this is what you would see. And what happened in the immediate thereafter, it went the opposite direction. Because why? That was a momentary pullback. There's another one for the S&P 500. This is what you would see, right? You see this. They're buying and buying and buying, and that's full buying. That's not just partial. And then what ended up happening? Came back down. Unfortunately, without a strategy, this is what people see. Now, these are charts these are just happen to be, current charts. These are like happening just a few minutes ago. I pulled them right before the webinar started just to show you that this inability to determine a true reversal from a momentary pullback is what hurts traders. This is how people lose money. The other thing now, again, like I said to you before, futures are based on algorithms, programmatic algorithms. So it's a little bit different than trading stocks or trading Forex. Forex is more based on, those are currencies. Those are based on more like what's happening in the country, as opposed to futures, which are truly algorithmic, based on programs, computer programs. And with that, there are companies out there that teach you how to trade what's called money flow. Then you watch these dome, what's called a dome. This is an actual trading ladder. And in it, it shows you at the very current price, it shows you what the current price is, the bottom pink and the top blue. Those are your current prices. One is a bid, what you can buy something for. One is an ask, which is what you can sell it for. And so the market goes back and forth between the bid and the ask all day long. So what happens is we do have something called robotic trading. And robots are pretty smart out there. And again, this is why you need to have a strategy for trading. The robots are really smart. So let's say that you want to get in this case, you want to get in right here, and you get in at 29.75. This is the S&P 500. It trades in these quarters. And you want to get a few ticks, right? Well, if you're a robot, what you'll do, let's say you get in at 29.75, but what you do is you put a whole bunch of trading contracts, potential contracts, and you put it way up here out of range, maybe at 29.32, 29.32.25, something out of range. If you're only trying to make 3 or 4 ticks, this is what you do. And you have the money to do it. You have to have a big account, and you put all this contracts that you say you're going to trade here out of range. Well, the way the algorithm works with futures is when it sees a lot of contracts in one direction, it tends to go in that direction. This whole concept is called spoofing. And because it's an algorithm, it says, oh, look, I have all these contracts that are ready to sell at this price. I better go get that price. So it starts to move up. Well, what happens with the robots, because they're pretty smart and their algorithms are pretty heavy, after about 3 ticks, wherever it is that they wanted to get out, so they sell whatever it is they were trading live, and then those contracts they put up at the higher value, they just kill those. They just cancel those trades. So they fool the algorithm. They fool the algorithm into thinking there are people out there ready to trade when there really aren't. Well, you would say, gee, that sounds pretty unethical. That sounds pretty illegal. Well, here's the deal. In December of 2018, there was a man who was charged by the CFTC. The CFTC is the controlling entity that controls trading of futures. And they charged this man with spoofing for doing this. So he decided, instead of allowing the CFTC to charge him, he decided to take him to court. And when he did, guess what? He won his case. And the attorney said, this is not going to happen. You're not going to charge me. And then the judge came back and said, it's not illegal to be smarter than your counterparties in a swap transaction, which is what a futures is. Nor is it improper to understand a financial product better than the people who invented the product. So what he was saying is, it's okay to spoof. This is why you really have to have a strategy, and why you have to defend your portfolio with that strategy and those 2 elements. Offense, how much you consistently can make in a trade, and defense, when to dump the trade when it goes against you. You must have those 2 elements. And when you're in a trade, even if it's a trade that, oh, I'm making all this money in this trade, if you know how much you can consistently make in that trade and you've made it, then get out of that trade. Because of this kind of spoofing, it can change in a heartbeat. I always tell people, do your strategy, get your strategy figured out, and then do that. Live by that strategy. If you have to make changes to the strategy, go back to the demo account and retest and retest. But don't, in the middle of a trade, give up on your strategy. If the trade is going against you and you know you can take a small loss, then take the small loss. Don't sit there and wait it out and wait it out and wait it out, because it may not come back to you, and it may get worse and it may get worse and it may get worse. So these are the kinds of things that we're going to show you in what we have in our 3-day webinar. Now, this is a full 3 days from 9 to 5 GMT. And you have to come prepared, because we take very few breaks. And we're going to show you strategies that you could use for yourself. Now, I'm not saying you need our strategy. We're going to give you all the elements, and you can develop your own strategy from that. Again, you never want to take my strategy, because you don't know the way I trade. You don't know anything about me. You want to develop your own strategy with elements. And what we're going to provide you are elements that you can use in your strategies. Tips. There are so many things you need to know how to trade the futures market. Because it's an algorithmic market, it's a little bit different. And there are a lot of things that have been programmed into those algorithms and the robots for trading futures. Down to the exact minute, I can tell you exactly what will happen, down to a specific minute, times of the day that they'll do specific things. activities, trends. These little tips, finding out about these little tips is essential if you're going to trade the Forex market, the futures market. And here's the thing about it. If we look at trading the futures market and we're looking at trading the Forex market, you'll find that, for example, if you're trading the S&P 500 E-mini, you'll find that the Euro USD is going to follow that as well. If the market is going up, if the S&P is going up, you're going to see that the Euro USD Forex is going to basically follow suit. So, and I'm going to show you, I can show you that the exact times of the day when the futures market is taking place, I can show that the Forex market is going to make similar moves. So there's a direct relationship during the day, if you're looking at day trading, between the Forex market and the futures market. Even though the Forex market is more currency-based, long-term, they're going to do whatever they're going to do, but short-term for day traders, if you're interested in being a day trader, short-term, you'll see that actually they are related. And that's why it's great to trade the futures market, because it's going to drive your Forex trades. So even if you're a Forex trader, I suggest you bring up a futures chart and watch it, because you'll see how much that futures chart impacts your Forex trades. Here's some examples of what we teach in the 3-day webinar. First of all, you're going to learn about market direction. You're going to learn how to identify the difference between a momentary pullback and a true reversal. If that webinar taught you nothing else except that, nothing else, that webinar would be worth gold, because that's the thing that will stop you from being a long-term trader. I'm going to show you what the institutional professionals, the bankers, actually do on what are called market trading days. And you have to know what are the days, and every day they do a very specific thing. You're going to learn how momentum drives that market, what the actual usage of moving averages is. Now, most people think, oh, moving averages, and trust me, there's so much more to moving averages as part of a strategy that you can develop. You've got pivots, you've got regressions. Regression is all about algorithms. It's all part of trading futures. We're going to teach about spikes. I showed you some of those spikes today and what you do when you see a spike. And we're going to show you how to develop your own trading style. That is why it takes 3 days in a webinar, because there's so much to go over. And here's the thing, we've developed a whole bunch of indicators. I showed you one indicator that shows you live how people are actually trading inside that moment. We've developed a whole bunch of indicators that are specifically for trading the futures market. And they are useful in helping you develop your own strategy. So we could charge a whole bunch of money for this 3-day webinar, but we don't. We're only charging $150. And here's the best part about that. That webinar is recorded. So you can watch it again and again. If you can't do all 3 days, no problem. It's recorded. You can come back and watch it. And with that, I'm going to turn this back over to Matt. And I thank you for listening. I hope it was educational for you. If you have any questions, be sure to call us. Be sure to put them on the questions right here. We'll be sure to answer them. And with that, let me turn this back over to Matt.
Perfect. Thank you very much for that, Barbara. I hope everyone in the room managed to learn something today. Just like we said before, the webinar will be available for replay. So once we finish, if you just visit this page again, you'll be able to watch the whole webinar from the beginning. If you miss some parts, you could just go back and watch them as well. What I'll do now, you'll see on your screen, you'll see a small pop-up. This is where you can actually join in the 3-day webinar that Barbara just talked about. I see there's a question right here that says, do you use the Dome in the webinar? From what I know, Barbara does teach about the Dome in the webinar, in the 3-day webinar. If you have any questions about what is going to be included in the 3-day webinar, you can send us an email at webinars@ampglobal.com, all right? Or support@ampglobal.com, any of those two email addresses. But apart from that, we will keep this webinar room open for another 10, 15 minutes. So you can post some questions. You can ask anything you like on the questions tab in the right-hand corner. And apart from that, that's it from me. We really want to thank everybody who showed up. We appreciate it. And we'll look forward to seeing you in the future.